Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and I would like to continue our discussion on portfolio diversification. So let's take a look. Why is holistic approach is very important to a portfolio? Trading plan and psychology of a traders is a very important topic. It drives our everyday decisions. So you can have exposure to a given name and be comfortable with this. But if you have too much exposure to the market in holistic view by looking at the summary level of all of your individual positions, you might have too much the exposure to the market. So it's very important to have tools to help you understand if the market sells off, how much money you can lose. So traditionally, you can have a long, short equity fund, and we talked about this in our previous sessions. So you could, at Tradespoon, we provide you with recommendations both long and short to help you minimize exposure to the market. So if the market sells off, your short position will benefit. You can go to tradespoon.com and look at our portfolios that we are recommending. The second way you can minimize your exposure is to look at the beta, right? We talked about in our previous session looking at the beta and Sharpe ratio to minimize your exposure to the market by trading stocks that have low volatility and relatively low beta, but have high return on capital. The third way you minimize the exposure to the market is by diversification. So you have different ways and tools to minimize the risk that you have for your overall portfolio. So if you open up an account at Tradespoon, you can actually create a portfolio using portfolio analysis tool, which you can see on your screen, and it will show you not only the beta and Sharpe ratio for your overall portfolio exposure. If you have option position, it will also show you Greek analytics. It will show you what is the delta, what is the theta of your overall portfolio that can help you to show you exposure to the overall market. And it will also show you sector diversification. You do not want to place all of your trades into one sector, like technology or consumer staples or utility, because if, let's say, interest rates go up, then utility sectors will sell off. And then if your portfolio is not diversified enough, you will sustain unnecessary losses. So diversification is very important. You should have, at any given point, depending on how much experience you have, you should not have more than 4 to 12 positions at any given time, unless you're more of an active and day trader. You should invest in different sectors that are not highly correlated to each other. So utility sector is not correlated to technology sector. We talked about correlations before. Consider positions in utility staples, discretionary technology, financial and medical sectors. During the market correction, utility and staples outperform the spider. So if you want to diversify your portfolio and minimize your losses during market sell-off, consider having exposure to utility and staples that pay you a steady dividend, but also will hedge your overall risk if the market sells off. You can find more information if you visit tradespoon.com webinars, and you can also follow us on social media. Thank you.